Okay. Hi, everybody. Welcome to our third and final session of our income tax planning for farms that file a Schedule F as part of our CCE Farmer Tax School series. We're so grateful for you all sharing your past few Wednesdays with us. We hope that you've taken some really helpful information for your farm, and we've convinced you to start thinking about income tax planning. And if Dayton, Nicole, and I have not managed to do that, we are grateful, excited, all of the things to have Paul Vandenberg from Farm Credit East here with us this evening. He'll be running tonight's presentation after we get through some introductions here. And we're really excited to have his expertise and his skills here to help give you guys some strategies to take home the foundations that we've kind of been talking about for the past couple of weeks. So just a couple of housekeeping things as we've done throughout this series. Please use the chat function to ask questions. We do have a packed presentation tonight with all of the wonderful questions everybody submitted already. So there might be some questions that we don't get to, especially for the ones that are very specific to your farm. So our plan is I'm working on collecting all of those questions, and we will put together a document that will be sent out to everybody that will have answers to those questions. Everybody's muted without video. If we get to the end and we've got time and you have a question that you'd like to unmute and ask, we will offer that opportunity. Otherwise, keep your mic and your video off to help kind of get rid of the background distractions. And everybody will receive an email with tonight's recording, and you all should have gotten session 1 and session 2's recordings. And for those of you that requested paper mailings, those are going to go out on Friday, and those will include everything. So the final versions of the presentations, the new farmer's tax guide, and that Q&A document that we mentioned. Disclaimer, again, this information is for educational purposes only. We do recommend that you work with your own specific accountant on topics that are specific to your farm. So we've done our best effort to provide correct and complete and up-to-date recommendations, but errors are possible, and it's always a good idea to connect with a professional for things that apply directly to you. And just wanted to thank our sponsors again, 2020 Consulting, MBT Bank, Farm Credit East, and New York FarmNet. We appreciate their support in letting us put this series on and being able to offer it at an affordable price to everybody and include those scholarships. So as an overview, sorry, Paul, I spelt your name wrong right off the bat here. So we're gonna set that expectation bar real early. So Paul's gonna be steering tonight. We're so excited to hear his presentation. We do have those Q&A questions that you submitted. And one important note is that we will have an evaluation for this series. We really are planning to read your responses, so we appreciate you sharing time with us to share your thoughts. And those responses will actually help to shape the next 3 courses in this series and shape our future farm business management programming across the state. So this is the link that will be in your slides. It'll be in your follow-up email, and I'm going to drop it in the chat. If you're like me and forget to do things as soon as you walk away from them, I would encourage you to go ahead and open that survey up right now on whatever device you're watching this, so it's ready to go as soon as tonight's session is over. And just one other touch point to talk about is, as we go through tonight's presentation, we want everybody to go back to your why bother income tax planning goals. So how do the strategies that Paul's going to present tonight apply to you and your farm and your income tax planning goals? And how could you utilize those to better reach your income tax planning goals? And with that, I am going to turn off my screen share, and Paul, you can take it away. Thank you.
Well, thank you so very much for having me and everyone joining us today. And I will try to get our slideshow started. Everyone should be able to see my beginning screen. just to give a little bit of a background for myself, I started with Farm Credit quite a long time ago, 1984, in the Herkimer, New York office as a loan officer. And I transitioned into full-time tax specialist and head of the tax department in the Cooperstown office now. Been in the tax department, goodness, probably 18 years as kind of the leader of the office where I've been. I've done a lot of tax returns over the years. Knock on wood, I've been involved in few audits. Remind me, Caitlin, if you will, that I want to circle back and around and talk about 2 audits in our office right now before the end of the presentation. I did not put any slides in there, but it may be of interest to some of the people on the call.
We'll add that to the list. Thank you.
Okay. I am in Central New York. I know an awful lot about dairy farming, dairy taxation. As with any specialty, I know when to say when, and I am not a specialist in all arenas of agricultural taxation. And I will point out that I don't have any orchards at this point in my portfolio. Some very unique tax rules and regulations regarding depreciation, reporting of income, things of that nature. I guess why I put that out there up front, I would recommend you work with people that know your business and take a vested interest in knowing your business. Our industry has adapted over my career. There's fewer dairy farms where I work now. There are many other types of agricultural enterprises. We work with all of them. So with that, I will move on to my presentation. And please, if you do have questions, I thought I had the text area open, but it closed on me. So I'm going to count on Dayton and Caitlin to watch the chat for me. If there's questions that are appropriate to the area in which I'm presenting at the time, please interrupt me. Just the train of thought, I think, will be more conducive. So strategies for tax planning. My first few slides to me are pretty basic, but you want to be informed and you want to be engaged. You want to know, like you are this evening, some of the basics of taxation, specifically agricultural taxation. And you want to engage with your accountant, with your tax professional, how your decisions impact your business. Very generally, and this is over 38 years of experience, about the best you can do, tax planning wise goes, is to take the peak out of a high income year and take the valley out of a low income year. If you can do that in the long haul, I think you'll find it to be best for your business. Best as in paying hopefully the least amount of taxes over that whole period and not losing the value of standard deductions. We used to have personal exemptions or tax credits. I look at tax planning as trying to maximize people's tax credits at the minimal amount of tax that they have to pay. There are different phases that people go through in life. At just the beginning of a business, or in the growth phase of a business, or in the maturity stage of the business. Different goals will surface and you need to communicate and engage with your tax professional to keep all things relevant. I talk about knowing the tax brackets. To me, a lot of this planning, tax planning, is frankly knowing tax brackets. And I jotted down very quickly, it's not on a slide here, but for the 2021 tax year, the year in which we are in right now, the married filing joint standard deduction is $25,100. A single person is exactly half that, $12,550. On the federal return, there are no personal exemptions. Those went away a few years ago with the standard deduction becoming so large. The other number that I want you to consider is $105,900. Married filing joint, $105,900. A married couple with only capital gain income, excuse me, with only capital gain income of $105,900 pays 0 federal tax. Knowing the tax brackets. You don't need to overspend if your eventual taxable income is comprised only of capital gain income. More to come. Ordinary income versus capital gain income versus income that's subject to Social Security tax, self-employment tax, the SE tax. My presentation is mostly going to be directed towards the sole proprietorship, the individual taxpayer, not entities. So an individual may have a Social Security tax liability, but not have any ordinary income tax liability. Well, how can that be? Suppose I have $10,000 of self-employment income on a Schedule C or a Schedule F. I'm going to pay roughly $1,413 of Social Security tax on that. I will pay 0 federal income tax. In fact, I'll likely get a refund. How could I get a refund? But I'm paying Social Security tax. Earned income tax credit. There's a sweet spot to having income, paying into the Social Security system, and receiving a tax credit on the other side. How sweet is that? And what other factors may need to be considered? What's going to be in the future? Are you in a growth mode of business operations? Is income going to explode in the next few years? Is there a big future expense on the way? Is there a farm sale on the way? Or a farm purchase? Tuition. Young families trying to fund education costs for their children. The FAFSA application, financial aid applications, drive from the tax return. There are certain things with preparation of the tax return, depreciation specifically, retirement funding, we can impact the adjusted gross income that drives the tuition calculations on those FAFSA applications. You have to keep your eyes open to that. And retirement funding. Social Security tax, first thing. You don't get anything out of Social Security unless you put something into it. And it's a misnomer if you think that, well, I've got 5 years before I'm going to retire at age 62. I'm going to start paying into Social Security so that I can get a decent monthly Social Security check. It's not going to happen. It's too late. The earlier years in one's career are indexed for inflation. I'll pick on myself. My early career earnings at Farm Credit are likely worth more from the Social Security standpoint than the ones that I have right now because they're indexed for inflation. In order to replace those earlier years, I'd have to pay a whole bunch more in Social Security tax. Not very appealing. And then it would only move the eventual Social Security benefit $10, $15 a month. Not a very big payback. So those are some of the other factors that need to be considered. I mentioned before tax credits, earned income tax credit. There's a sweet spot. Married filing joint, roughly $12,000 to $25,000 of adjusted gross income or earned income. And you could be eligible, depending on the number of children that the family may have, $5,000 to $6,000 of earned income credit. Way more than the Social Security tax on a $15,000 self-employment income, for instance. Decisions that might be able to be made with your accountant that influence your tax liabilities. Not necessarily a decision that's made filing status, but I've had just a few instances recently where a married filing joint customer actually benefits by filing married separately. I do both returns, the husband and the wife, but collectively they end up paying less tax if they file separately. Not a whole lot, maybe $1,000, but by having my eyes open and looking at that, I look at that as I've paid for my fee and then some. Cash versus accrual reporting. I think you've discussed cash and accrual in previous discussions the previous weeks, but in generalities, 99% of the clients that we have are reporting on a cash basis. It's way more flexible from an income tax planning standpoint to continue to report on the cash basis than it is accrual. Why? In the accrual environment, income is reported when earned, not when you receive payment. Let me repeat that. Income is reported when earned, not when you receive payment on the accrual method. One of the questions that was posed to me was kind of specific to an apple orchard where income is received in a future year after harvest. If it's been shipped and delivered and billed, that's a receivable. That's income in the year that receivable was created. It's not income in the year that cash is received. That's the accrual standpoint. We have very few accrual filing farm returns. Much more flexibility in reporting income and expenses on the cash basis. More to come. One of the biggest areas of tax planning, prepaid expenses. In the cash basis reporting, a prepaid expense, something you purchase now, you're going to consume it in a future. The reverse deferred revenues. A few years ago, we were using milk check deferrals. We would contract with the milk company. Here's my milk we're going to deliver to you in the month of November. Normally, we would get paid for it in the month of December. I don't want to receive that December milk check. Pay me in January. That's a milk deferral. Has to be done by contract. On the cash basis reporting, absolutely legit. Not possible on accrual reporting. Capital purchases. I am not one to advocate simply purchasing capital items to reduce one's tax liability. Oh yeah, it's a great way to reduce tax bills. But by the way, you just bought a big asset. that probably isn't worth the day after what you paid for it, right? It's like buying a brand new car off the lot. You put the key in it, you drive off the lot. There's lost capital. It's not worth what you paid for it as soon as you left the driveway. If the business knows by planning it's going to have a capital expenditure, it knows it's going to be needing a tractor, planter, whatever, then you have to have the discussion with your accountant. Do I acquire that this year, the current year? Do I delay and do it next year? In the times of COVID, in which we are living now, and you're looking at capital purchases as a potential area for tax planning, word of caution, there is less iron on the dealership lots. Supply chains have been totally disrupted. If you're looking for a specific piece of equipment, it may take you some time to locate that equipment. That's another consideration to take into account as you're trying to lay forth your capital purchase plan. With capital purchases come a whole array of depreciation options. Depreciation, what is depreciation? That is the tax deduction for having made a capital purchase. It's the expense deduction for a capital purchase. There are quite a few rules about how that depreciation is calculated. I've got a few more slides further in, but there is a huge, huge area that you can adjust your net income with decisions revolving around depreciation. One of the things that I would point out on that whole list, depreciation is a consideration that it is only made, that can be made after the end of the tax year. You don't have to make the depreciation decision today or tomorrow or by December 31st. You have until you file the tax return in making those decisions. Very powerful.
Paul, do you have time for a question? I
Go
have
right
one
ahead.
or two in the. All
Yep,
right,
go ahead.
let me get in the chat box here.
Okay, here I got it open now. Yep.
Okay, so maybe you can see. There's a couple in there.
Okay,
like
so our first one is talking about a SEP IRA account as a retirement plan to lower tax liability. No, not. I don't think you can set up a SEP now for the 2021 year. That had to have been set up by October 1st, I believe. A SEP IRA, I haven't seen many SEPs. I've seen simple IRA plans. There's requirements in funding employees that wish to participate in the plan. But normally those accounts have to be set up by October 1st so that the employees have 3 months to elect into the plan. Can you provide a guesstimate on depreciation of pattern drainage of fields? I believe that's leasehold or a 15-year depreciable asset drainage. It could be 7 years if certain things apply. 20 acres, $20,000. Depreciation on that could be very small. I'm talking like $20,000 divided by 15 divided by 2 is $666 all the way to $20,000. You could get all of it in 1 year if you wanted. Depreciation could be that skewed. Those are the two questions, Dayton, I think I had. Okay.
Yes, Paul, I think so. Yep, thanks.
Okay. Yep. Lastly, large debt payments. And I put this right in there next to depreciation options. I really like to use depreciation up as cash has been used up. What am I meaning by that? I purchase a big tractor, $400,000 tractor, but I got to borrow all of it from John Deere. And I know I've got this huge tax liability this year, but I can get rid of that by buying this tractor. I got a $400,000 write-off. The problem is going to come into play next year and the next year while I'm making those big principal payments on a $400,000 loan. I won't have a tax deduction in those future years, if you will, to cover those principal payments. You will be making principal payments with after-tax dollars. That can be pretty expensive. So I like, if I were going to be very aggressive in depreciation, and by aggressive, I mean I'm using Section 179 as a direct expense, like the drainage example, $20,000, all of it used up in 1 year. I hope that's not financed. If it's financed, I would look for something else to write off, or it not exceed the amount that was paid for out of cash. That's another way to look at it. If you used cash to buy some other asset, but financed one, you can pick and choose which assets to depreciate completely, which ones to depreciate over time. So that's what I'm trying to say, that there's an interplay in my mind with large debt payments in the future and how aggressive we are with depreciation deductions. Oops, I think I gotta click in the cell here. Leasing. With the depreciation options of late, frankly, leasing equipment hasn't been as attractive, with maybe two exceptions. Leasing is simply, in my eyes, another avenue to finance the piece of equipment. I'm coming from the standpoint that ultimately the farm is going to own that piece of equipment. It's not going to surrender it back to the leasing company. Number one. Number two, the deduction for the lease expense is right on the return. It ties up beautifully with the cash. The deduction and the cash effect are matched up perfectly. A third option, a third reason for leasing, it's simply another avenue to finance, and it frees up the farm's cash flows for other capital needs or other cash needs, if you will. Leasing of buildings, we're finding still quite a lot of interest, if you will, in leasing buildings. Now here, it takes money to play the game, folks, okay? A general purpose agricultural structure is normally depreciated over 20 years. Yes, with the special depreciation allowance, you can deduct all of that in 1 year, the first year. But if you don't want to go quite so far as that, if you want to do deductions over time, IRS hamstrings you and they say 20 years. Leasing that building would get your deductions down to a 7 to 10 year term, buyout at the end of the lease. It's another avenue to increase your expenses and benefit the farm in that respect. Timeline for tax planning. It's always tax planning. It's like, when did the tax season end? I don't think the tax season has ended for me for 3 years. I say that kind of jokingly, but honestly, it's kind of been crazy with COVID over the last couple of years, and extensions and extensions to the extensions and what have you to the tax season. It's really, in my eyes, it's always kind of time for tax planning. You finish one tax return, you're into the tax planning mode. What drives tax planning? You have to have good financial records. They have to be kept up to date. Good financial records is more than, well, I've got $10,000 in a checkbook. I got a tax problem. The checkbook doesn't give you the tax effect. It doesn't give you the financial picture of the business. It's only one little segment of the financial picture. That cash in the checkbook could be there because of money borrowed, money contributed, not just earnings. So don't just look at the number in the checkbook. There needs to be a good, accurate accounting that's kept up to date. You have to share your income and expense statement with a tax accountant in the fall. We're starting tax planning right now. The end of October. It's very common for us to see some of our larger clients two times before the end of the year. And you have to discuss the tax planning goals and strategies and then make a plan, report on that plan. Implement that plan before the end of the year, track the progress, report back on the progress. Ultimately, you end up compiling the data and filing the tax returns next spring. Then you pay the tax. Not in the slides here. I'm going to share some hints and tips, if you will, about filing farm tax returns. If a farmer, and by farmer, I'm saying the IRS definition of a farmer, is that 2/3 of your gross income has come from farming enterprises. 2/3 of your gross incomes come from farming, okay? So I'm from the standpoint, a qualifying farmer. If I had a refund on last year's return, I don't have to file and pay by March 1st. I don't have to make estimated tax payments. I have until April 15th. If in the completion of the 2021 return, I owe $1,000 or less, I don't have to file and pay by March 1st. I don't have to make estimated payments. I need to file and pay my tax by April 15th. The challenge is, how does anybody know they're going to owe exactly $1,000 or less on March 2nd? Tough call. So to circumvent an underpayment of estimated tax penalty, farmers are allowed to make one estimate on January 15th, by January 15th, for this year, 2021, by January 15th of 2022, the estimate has to be 2/3 of last year's tax, 2/3 of this year's tax liability, or 100% of last year's tax liability. Well, I'm good, but I'm not so good as knowing exactly on January 15th what somebody's tax liability is going to be, so I can calculate 2/3 of that. I'm pretty good. I can figure out how much 100% of last year's tax was. Okay, so that is the requirement for farmers, qualifying farmers, to pay estimates or when they should file and pay their taxes. If they owe more than $1,000 on the current year, if they paid tax in the prior year, they have to file and pay the tax by March 1st. March 1st. So 2/3 of farm income. There's a text chat in here about $10,000 gross in New York State. There's a lot of non-farmers out there. There are a lot of non-farmers out there. And that the estimated payment requirement, it's easiest to fall back on how much was the tax liability in the prior year, and then make sure that you've paid at least 100% of that in quarterly throughout 2021, and ultimately by January 15th of 2022, that's the fourth quarter's payment due date. You're supposed to take last year's tax liability, 2020's liability, divided by 4, and pay it quarterly, April 15th of 2021, June 15th of 2021, September 15th of 2021, January 15th of 2021. Now, I don't know about you, but April 15th, we got another extension. On April 15th of 2021, we were told we had until the May something to do tax returns. But they did not extend the first quarter's estimated payment date. So for the quote unquote non-farmers out there who did not make that April 15th payment for the 2021 tax return, there likely will be a penalty for underpayment of estimated tax. That's going to be a problem when we go to file the 2021 returns next spring.
Paul, there's one more question in there.
One more question, I'm sorry.
Yeah, up above the one you just.
Okay.
Yeah.
Should you match expected useful life and financing term of equipment to the depreciation schedule? Ideally, I would say yes. It's somewhat that the answer to that question is somewhat dependent upon cash flow of the business. And I like matching up useful life with the financing terms. And I'm going to pick on my dairy farmers with skid steers, skid steers and manure spreaders, you know, couple 3 years and they're kicked, right? Financing the things over 7 years, probably not such a great idea because you're going to have to replace the thing after 3. So financing the asset in 3 years term makes a lot of sense. The challenge is I can't get you depreciation deductions exactly to match a 3-year term. Not allowed. New equipment is 5 years. Used equipment is 7 years. I don't make the rules. I just got to live by it. Doesn't make much sense that a used piece of equipment is depreciated over a longer period than something brand new. Thank you very much, Congress. May I have another? I've got another text chat. We have off-farm jobs and our farm is not 2/3 of income. Can we still file Schedule F for the farm if we are over the 10,000 income? We're just starting our farm. I would absolutely file a Schedule F. You have farming income. You are not a farmer in the eyes of IRS, but you have farming income. You're selling chickens or selling meats or vegetables or whatever. That is farming income, and you have farming expenses, supplies, fertilizer, fuel, blah, blah, blah. Bear in mind different rules for estimated tax payments between farmer, quote unquote, non-farmer. Tax brackets. I alluded to tax brackets earlier in regards to $105,900 of income, married filing joint. If it's all capital gain income, tax is 0. How sweet is that? That's huge. That's a big number. Not everybody's got only qualifying capital gain income, however. Much of our businesses have ordinary income, or we may have wages or investments, interest and dividends. Those ordinary income items would be reduced by the standard deduction, leaving capital gains as being taxed. Capital gains in a 12% tax bracket, in a 12% tax bracket, up to $80,000 of capital gain income, $80,800, for 2021, is taxed at 0. It's pretty darn good. Knowing tax brackets. I don't have a slide for this. I am honestly using my cheat sheet, okay? Married filing joint, the 12% tax bracket goes up to $81,050. So an individual, there's no personal exemptions. So that even if you have children, the standard deduction is not increased with personal exemptions. Effectively, 81,500 plus 25,100 is in a 12% bracket or less. Then it jumps to 22% from taxable income of 81,50 to 172,750. That's a pretty healthy increase, 12% to 22%. And then there's some steps above that, 12 to 22. 22 goes to 24 from 172,750 to 329,850. You're paying marginally 24 cents on the dollar on every dollar earned in that tax bracket. Dollars earned below that tax bracket are taxed at the lower bracket rates. This is not that everything is taxed at 24%, only the marginal dollar, that next dollar of income. I hope I've driven home the concept of zero tax bracket on capital gains in 2021, $80,800. That's a pretty big number. Retirement plans. This is one more item that's open for discussion, if you will, with your tax professional after the end of tax season. You don't have to fund IRA accounts before the end of the year. You have until April 15th to fund your IRA contributions. And I hope you realize that there are two types of IRAs. There's a traditional IRA account. There's a Roth IRA account. First, the traditional. A traditional, take a tax deduction on the current year's tax return for the amount of dollars contributed into the plan. Up to $6,000 under age 50, $7,000 age 50 and over. When you take a distribution from that retirement plan, from that IRA account, you will pay income tax on all of the distribution. The Roth IRA account does not beget a current tax deduction, but there's no tax when you take the money out. So it grows tax-free. Right behind this is tax credits and deductions. Married in with retirement contributions, there is also a retirement savers credit. Takes money to play the game. I've said that a couple of times. You got to put money into a retirement account in order to gain some tax credits. If the tax return lines up in the right amount of adjusted gross income, in this sweet spot I've said before, the tax credit for making a $2,000 contribution could be $1,000 bucks. $1,000 of tax credit available to help pay ordinary income tax. Very narrow window, but just be cognizant of a retirement savers credit in completing tax returns. Relatively low threshold to adjusted gross income. I'm going to say it's less than $60,000 on a married filing joint return. It may even be less than that, like $40,000 on a single person. So you don't, when this first came out, I really didn't think the retirement savers credit was going to be worth very much because, I mean, really, is somebody with an adjusted gross income of $20,000 or $30,000, do they really have an extra couple $1,000 bucks to fund an IRA account? It's going to be a stretch in a lot of cases. It's just something to be cognizant of and discuss with your tax preparer. I think we're all getting smart enough to realize that Social Security on its own isn't probably the greatest retirement plan. You better have some funding of your own set aside outside of the farm. When I first started my career, I know that the majority of my clients looked at the farm, that asset, as their retirement plan. Yeah, probably not such a great idea, because Uncle Sam's going to have their hand out and you're going to pay income tax on that sale. We've got a lot of tools to help with reducing the tax effect on sales, but retirement funding should be elevated on everyone's radar. Should you make year-end gifts? Year-end gifts are not tax deductible. They are not taxable income to the recipient. They're not tax deductible to the individual. I'm talking gifts between individuals, not gifts to charitable contributions, charitable organizations. I know there was a text chat that just came in, and thank you. IRA contributions can only be made if there is earned income. It takes money to play the game. You have to have earned income. I don't think I have a slide for this, but I'll address it here. Suppose the farm is operating at a loss. That's not going to result in earned income. There is an option to elect optional Social Security coverage, and that would then beget earned income that would allow you to make an IRA contribution. Jumping back to year-end gifts, $15,000 is the annual gift exclusionary amount. I believe this year, if it's cash of up to $15,000 per year per person, there's no gift tax consequence. You don't even need to file a gift tax return. If the gift is in excess of $15,000, you're supposed to file a gift tax return. The upside is, at this time, you don't write a check out just because you file a gift tax return. The impact is in your eventual estate. The amount of the gift in excess of $15,000, I'll refer to as an excess gift. The excess amount will reduce the amount that can eventually pass through your estate tax-free to the beneficiaries. I'm not an expert in estates. It's some big numbers. Something over $10, $11 million, an individual can leave and not paying any estate tax. That's not the case in New York. New York has their own tax and that on estates, and that kicks in at a lower threshold. So if you have an asset base above 10 million, then I would start to get excited about, congratulations, number one. Number two, that takes some good planning, constant planning, to see that you're not exposing your eventual estate to some pretty healthy taxes. 40% is the starting tax bracket when you start into a taxable estate. Income limitations for IT 217. What the world is IT 217? IT 217 is one of my favorite forms. It's the New York State Farmers School Tax Credit Refund Form. We spend a lot of time with our farm clients maximizing their credits, this being one of them. In very profitable years, there is an income limit. If you exceed, and I believe the number, if you exceed $200,000 of gross income on the New York State return, the amount of farmer school tax credit that is available is reduced by a percentage of an amount of income over $200,000. there's a little twist in that. And the twist is this. You can reduce the state adjusted gross income by the amount of principal payments made during the year. That's kind of an interesting twist. The two are really not related at all. Principal payments have to do with loan payments. And I don't believe the requirement from the state forces you to only use principal payments on mortgages. I think you can use principal payments on all farm-related debt, even operating debt. So if you tend to prepay expenses in the fall with borrowed money, the next year you're paying back a lot of principal payments. If you have a high income, you might be able to utilize those big principal payments to still qualify for the farmer school tax credit. There's a question in regards to qualifying for the farmer school tax credit. 2/3 of the gross farming, 2/3 of the gross income of the tax return has to come from farming, over and above the first 30,000. And I probably didn't say that very well. There's a worksheet with the farmer school tax credit, IT 217. And the worksheet basically does this. It takes the gross income reported through somebody's return, wages, interest, dividends, gross rental income, that's gross. Gains on stock sales, gross farm income, gains on sale of machinery, livestock. Losses are disregarded. Add that all up. From that big number, take $30,000 off. New York is assuming that you're going to have $30,000 of income from outside sources. I guess they give you that. Now that reduced number is your denominator. Now go back through and tally up again the farming sources of gross income. Gains on livestock sales or machinery sales, Schedule F, the farm rental schedule. That's your numerator. Divide, it's got to be at least 2/3 from farming. If you've got big wages, you got to have some really big gross farm income, gross Schedule F income. Again, my presentation is really 1040 driven, individual reporting. Gross income is also passed through on pass-through entities of partnerships or S corporations, partnerships or LLCs. I think that's covered that one. I find it's really my job to probe the business, to find out where they're at, where they want to go, what are their plans are, what is their tax appetite. Tax appetite, are you kidding? Well, not really. I mean, are they willing to pay some tax? Are they willing to pay some Social Security tax? I hope so. I don't like the tax plan to zero, honestly, because frankly, it leaves tax brackets available, low tax brackets. And if there's going to be a sale in a few years, why defer income and even make a bigger bubble? If I can take that valley out today and take the peak out of tomorrow and level things through. That's kind of where I go with that. So there's different parameters, high income years, low income years. And there's different things that we can do to help reduce the tax liability, either in the current year or for a future year. A very typical maneuver for high income years is defer income. I mentioned before the deferred milk sales, accelerate expenses, prepaid expenses, and not including on that list, well, open accounts. If you've got any open accounts and you've got a high income year, an open account is a bill at the supply store that I haven't been able to pay off yet. Well, shoot, pay off the open account. That's a current deduction. So it's not an expense of the future, it's the current year. Pay those expenses so that the expenses are matching in with the income year. A low income year is really the alternative of above. Accelerate income. And let me go back to this, accelerate income. We've had some low income years in the past. One of the maneuvers, one of the tax strategies that we would try to implement would be to force there to be income in that year. How would I do that? Well, let me give you the scenario. A farm business has been relatively profitable through the years, funded traditional IRA accounts every year. We've now accumulated some money in a traditional IRA account, but we're going through a down income year. We actually end up with a loss on the tax return. I can see the loss coming. It's like deer in the headlights. This is going to be a really bad income tax year. I'm not too excited about net operating losses. There's a lot of strings attached to net operating losses. Do I carry back? Do I carry forward? Oh, it's another whole topic. But what if I forced there to be income in this year to use up that business loss in the current year? It's not that I'm going to just go out and find a $100,000 job. What if I converted $100,000 of my traditional IRA account to a Roth IRA account? That conversion triggers a capital event, a taxable event. Well, now if I had an $80,000 farm loss and I convert $100,000 of IRA, traditional IRA funds into Roth IRA funds, I still don't pay any income tax. I've only got $100,000. I could earn $105,008. I'm not going to have a tax problem. And I'm sorry, I've got a $25,100 standard deduction. That's more than 20. And now I've converted $100,000 of deferred taxable income to no taxable income in the future. How great is that? That maneuver you got to do before the end of the year. So you got to know where you stand in order to pull that trigger at the right time. I'm going to spend a little bit of time about prepaid expenses, some requirements. We see prepaid expenses for feed, seed, fertilizer, similar farm supplies. There's some limits here. You can't have prepaid expenses in excess of 50% of the farm's total expenses without regard to that prepaid expense. On our large operations, that isn't really a problem. On smaller businesses that are trying to utilize prepayments for tax maneuvers, you might need to be careful of this 50% limitation. In addition, the payment has to be for the purchase of that feed, not a deposit. It's not money on account. The feed company is not going to give me interest just because I made a $10,000 deposit. No, I bought $10,000 worth of feed. X amount of feed. There has to be a business purpose. It's not merely for tax avoidance. The prepayment does not, in this quote, does not materially distort the income. Don't write the rules. I just gotta, educate people about the rules. And there's other facts and circumstances. How are we doing on time? Dayton, we're okay on time?
Yeah, Paul, we're doing good. I think we're wrapping up about 8:15, 8:20, a little time for questions.
Okay.
There are a couple questions in the chat box there if you want to take a look at them. I think actually some of them are above the one that you answered. Might need to scroll up.
I'm missing it, I guess. Gifts apply to family members. I'm available to receive gifts. Anybody want to make a gift to Paul? I'm good. Facetiously. In regards to gifts, it's the limit for reporting gifts is $15,000 per person per year. I'm not talking about charitable contributions, charitable donations, and things of that nature. There's no reporting for making a gift between individuals up to that $15,000 number. I don't know if there were any other ones that I've missed along the way. I apologize if I have. Please retype them in. We've gone through prepaid. So depreciation, one of my favorite near and dears. The 2021 Section 179 limit to $1,050,000. Folks, that is a big number. Tangible personal property, single purpose structures, silo grain bins, orchards, machinery. You can see the list. Drain tiles is Section 179 eligible. Non-qualifying property, the general purpose agricultural structure, 20-year property, not eligible. Tenant houses, nope. Machine sheds, it's considered general purpose. The investment limit now is $2,600,000. What's the relationship here, $2,600,000? If a farm business, or not just any farm, it's any business, purchases qualifying property eligible for 179 in excess of $2.6 million, for every dollar over, you have to reduce the amount that can be used for Section 179, that $1,050,000. So at 3.65, there's no Section 179 available. Hopefully I've covered that one. Property acquired by trade, only the cash paid is eligible for the Section 179. And there's some nuances in regards to trades that happened a few years ago. We utilize Section 179 if the majority of the purchases are in the last quarter of the year, the quarter in which we're in right now. If 40% of qualifying purchases happen in the fourth quarter, mid-quarter convention applies. You only get a month and a half worth of depreciation on this fourth quarter purchases. Pretty small number. You can use Section 179, skew the math. At least 40% business use. The asset has to be used at least 50% for business use in order to be eligible for any of it to be used in Section 179. And then the amount of that asset, the amount of Section 179 on that asset would only be the total business use portion, i.e. the 50% or more. There were some questions about capital.
Paul made a comment last week, and I think you'll just to talk about 179 a little bit. When I was working with you, which was a number of years ago, we won't say how many, nobody needs to know. Right. But Section 179, as I recall at that time, was $19,000. Right? It was that just floors me how high that is now. But
that's a big number, isn't it? 1,050,000. Right? That's a big number, Dave. Yeah.
Yeah. Yep.
And when I started, it was 10,000 bucks. Let's see, where was he? Repairs, incidental repairs. If it's ordinary and necessary business expense, it's a repair. It doesn't materially change the value of the property or extend or prolong its useful life. One of the questions that was posed was in regards to a greenhouse and the plastic on a greenhouse. I would venture to say the useful life in that plastic is not very long, and that's just a replacement of the plastic. It's going to be a repair. It's going to be an expense. Deducted. Yes, you're replacing the whole coverage. It doesn't have a very long useful life. When should I tax plan? Is income up from last year? Is it down from last year? Have I paid down liabilities? How much have I taken out of the business? Have I let payables run up? What capital purchases or capital sales are happening in 2021, 22? Is income higher than it has been since 2018? Why do I throw up 2018? Farm income averaging. Now, this is an interesting one. It's another one of our major things that we spend a lot of time on. Is if you can't tax plan out the peak and valley, you might be able to calculate the tax liability as if some of this year's bubble income was received in the previous 3 years. It's all math. It's all utilizing low tax brackets in the prior years. Low amounts that are still available in that 12% tax bracket, maybe up to that $80,000 of taxable income, and have that at 12% versus having it taxed in the current year at 32%. If you could take a few $100,000 out of a 32% rate and effectively have it taxed at 12 or 22, you look like a hero and you've saved a lot of tax. We have done this on many, many clients. I also want to point out, you can income average farming income. You had to have filed a Schedule F. It has to be farming income. You do not have to be a qualifying farmer. 2/3 of your gross income does not have to come from farming to utilize farm income averaging. That's a pretty unique thing. Why do I say that and want to drive it home? Younger people that haven't filed tax returns in the past, the tax brackets are fully available. There's been zero income in prior years, in the base years, 2018, 2019, 2020. Now this year we got a bubble of income. Maybe I've got a big job at Farm Credit East, okay? And I've got a few $1,000s of farming net profit, farming income. I can recalculate the income tax on my farming income portion and make it look like it came in 2018, 2019, and 2020 when I had zero taxable income. And guess what? I could pay zero federal tax because I had standard deductions that weren't utilized yet. So very powerful. Schedule J, one of my favorites. Absolutely cool. Are there tools to create a down year? Convert a traditional to a Roth. That's a tough one. Create a down year in order to convert traditionals to Roths. I'd rather not experience down years. I like to, in very general terms, if the farm business is making money, it's paying tax. It's a good thing to do. I'd rather pay some tax, kind of steady Eddie, than have swings of income. Very hard to deal with swings of income. Farm income averaging is one of those tools that we utilize. There is a limit in regards to amending tax returns. I'm reminded there's a 3 years worth of filed tax returns are open. Today's October 27th. That means the 2020 year, 2019, and 2018 are the only 3 open years. You cannot get back into 2017. You have 3 years open. You got to look at the numbers. Do I slow down expenses? Do I accelerate depreciation, prepay expenses? I didn't even mention one of the ways that we can slow down expenses to take a trough out. We can capitalize all the repairs. That's a depreciation discussion. It doesn't have to be done before the end of the year. It's done right up until the time you file the tax return. What's going on for 2022? I try to copy in now some of the submitted questions, and I'll try to go through these. And I grouped them kind of in categories. I will start right out with a topic that I hate, sales tax. Wow, sales tax is a minefield. Pardon me. There's all kinds of rules and regulations on sales tax. And I've done some sales tax returns. I don't profess to be an expert and know all in all things sales tax. But I will try to answer these as best I can. How does sales tax get reported on income taxes? Sales tax paid on a supply or purchase, a repair purchase, or something of that nature is simply deducted as an expense on those purchases. Generally speaking, if the farmer files a form ST, state ST 125, that's the New York State Farmers Exemption Certificate with those vendors, the vendors wouldn't charge sales tax on the purchase to begin with. So the requirement is the item needs to be used, and the word is predominantly, it's right from the form, and they define predominantly as used more than 50% in agricultural production. Used more than 50% hours of use, mileage if it's associated to a vehicle purchase. Hours of use, that's about it from the form. Do we pay sales tax on monies we charge for taking a workshop at the farm? I'm not sure I exactly understand the question, but if the business is attending a workshop at the farm for educational purposes, I don't think that is subject to sales tax. I don't know why it would be. Caitlin.
Yeah, I think I just pulled that one up. I think the question was meant to read as if the farm is hosting workshops and charging a fee for people to come to their farm, is that something that the farmer needs to collect sales tax on?
Yeah, and here I'm going to cry uncle. I know enough to say when. This is when. Paul doesn't know the answer right off the top of my head. I'll give you my gut answer would be no, because you're renting the facility. And I would charge rent for the shop, not that you're going to be charging other services with providing the workshop to the farm. If you provide the facility, I don't think that begets sales tax. If there's a service provided, sales tax is going to jump all over the top of the service. So are you supposed to pay sales tax on livestock animals we sell? I work with an awful lot of dairy farms. There's no sales tax on those cows sales purchases either way. Depends on the livestock that you're talking about. Horses. The horse industry has some very good lobbyists. And again, I'm sorry, I'd have to look up exactly here, but I just know that race horses, those are pretty fancy ones with big dollars attached to them. I don't think there's any sales tax on those animals. A pleasure horse, and you still may talk $5,000 for a pleasure rider horse, trail horse, I think you got to pay sales tax on that horse. Back into my comfort zone. Depreciation. I mentioned before, trades have been, the treatment of trade-ins has changed in the past 3 years, I believe. Used to be, if I want to buy that $400,000 tractor and I trade in a tractor that has $100,000 worth of value, the dealership provides $100,000 of value, and I now have to write a check out to the dealership for $300,000. That's old news. The new rule is there's a $100,000 sale of the asset that was traded, and the purchase is $400,000 to be depreciated. That's the change in depreciation regarding trades and the tax treatment on the trade allowance. There was a lot of discussion about a capital improvement versus an ordinary expense versus Section 179. And I didn't even mention here the special depreciation allowance. On 20-year property and less, the special depreciation allowance allows on the federal return for 100% of the cost to be deducted in the first year. That is huge. That's the special depreciation allowance. The special depreciation allowance is claimed on all assets of the same class. 5-year property is all 5-year property class. 7-year property, all 7-year property classes. Examples, 5 years. Trucks, cars, cattle, new equipment, 5-year property class. 7-year property class, used equipment, most typical one. We talked about capital improvements versus expenses before. I see there's a text chat in here to everyone. In general, services are exempt from sales tax, but there are some exceptions. Yeah, you got to look at the state website. There are a ton of helpful publications on the state website. Thank you for pointing people to that. I should have done that. Thank you. Sales of business assets. To me, we got to know whether or not the asset that was sold was previously depreciated. Was it a piece of equipment or a cow purchased? Or was the asset raised? Was the animal raised? Raised cows are treated differently than the sale of purchased cows. And I talked about trade-ins a moment ago. Why do we get all bundled up about raised cows versus purchased cows? Because the sale of raised cows held over 2 years of age results in long-term capital gain treatment. That could be taxed at 0. That's pretty cool. The sale of a purchased cow or any purchased piece of equipment for that matter that's had previously deducted depreciation, that sale may result in no income. It could result in all ordinary income. It could have some ordinary and capital gain income. I'll try to give you a quick example. A John Deere 4020 purchased in 1975 for $6,000 today is probably worth $10,000. If I bought that thing new in 1975, it's fully depreciated. If I sell it for $10,000, if I paid $6,000 originally for it, I would have $6,000 of ordinary income. I'd have $4,000 of capital gain income. Total gains, $10,000 bucks. That's how you can have capital gains on the sale of machinery. It would be on the sale price in excess, over and above the cost. Capital losses. Capital losses are deducted against capital income plus 3,000 bucks. So if there's a lot of losses, if you have a stock portfolio and it's had some unfortunate times, and you've had losses in that stock portfolio, my suggestion would be to go into that portfolio and try to find some winners and sell the gains so that you don't have more than a $3,000 capital loss combined. Raise cows. I'm trying to read here. Raised cows still considered that. Is a raised cow still considered that if we bought it as a calf and raised it and it's over age 2? No, that animal was purchased as a calf. That's a purchased animal. So you may have paid $500 as a calf, had it for 2, 3, 5, 10 years or whatever. You may have a capital gain on that eventual sale of that animal, but it is a purchased animal. $500 being the cost, and I presume that's the depreciation. Is anything taken on a 10-year depreciation? 10-year depreciation would be an asset class of a specific agricultural structure. A greenhouse is the first one that comes to my mind. Specific agricultural horticultural structure. Again, briefly about retirement contributions. Takes money to play the game. There's differences between traditional and Roth IRAs. You have to have earned income in order to fund IRA accounts, whether it's a Roth or a traditional. You can utilize optional Social Security coverage to qualify for having earned income in order to make IRA contributions. When you were talking about filing dates, what did you say about the date of March 1st? If you're a qualifying farmer and you have over $1,000 of tax liability for the current year, and you paid tax in the prior year, you have to file and pay by March 1st. If you file and pay after March 1st, you would be subject to an underpayment of estimated tax liability, a penalty. There was a few questions that I kind of lumped together here as regards of hobby versus business. And I've repeated here on the next 2 slides, the 9 points. I refer to them as the 9-point tests from IRS. And I literally copied these right from the IRS website. I Googled hobby on the irs.gov website, and these are the 9 tests. Whether the activity is carried out in a business-like manner and the taxpayer maintains complete and accurate books and records. Number 1 test. Keep business, business, and personal, personal. You have a business checking account, you have a personal checking account. The business account may need to have funds coming into it to keep the business going. Fine. Make a transfer of funds from your personal account to the business account. But all the business activity goes through the business bank account. Separation of income and expenses for your business makes bookkeeping a lot easier, and it's a lot cleaner. It further defines you have a business. You're not mixing personal funds in one checking account. Whether the time and effort the taxpayer puts into the activity show they intend to make it profitable. Well, those are the words. They intend to make it profitable. Prove it. Do you have a business plan? What business decisions are you making for it to be a profit? It is not uncommon for the beginning years of a business to operate in the red. IRS kind of expects that. but there is a presumption of profit. If 2 of the 5 years there has been a profit, you're deemed to have been in a profit mode. One of the areas that we have experienced audits in the last 2 years is in this arena. There, New York State is, in my opinion, picking on small businesses, farmers that have a farming loss, and there's off-farm income, and there's a refund due the business on the New York State tax return. I've had to defend several clients. When I say defend, we have to prove to New York State that the business is a business. It is not a hobby. Whether they depend on the income from the activity for their livelihood, that's a tough one to win if you have large off-farm income and large farming losses. You will likely never win on that one point. But not any one point is an all or nothing test. Continuing, whether any losses are due to circumstances beyond the taxpayer's control or are normal for the startup phase of the type of business. Well, out of the taxpayer's control. COVID, out of our control. Whether they change methods of operation to improve profitability. This is a conscious business decision. I'm changing my marketing strategy to capture XYZ market. Is there a business plan? The business plans all help document and prove profit motive, business intent. Whether the taxpayer and their advisors have the knowledge needed to carry out the activity of successful business, whether the taxpayer was successful in making a profit in a similar activity in the past. Does it have a life? Is it even possible? I think I mentioned before whether the activity makes a profit in some years and how much that profit was, whether the taxpayers can expect to make a future profit from the appreciation of the assets used in the activity. Appreciation is something that is not going to show up on a tax return. It's an increase in the value of the assets. You're only going to show appreciation when there's an eventual sale. I've had to use this argument quite a few years ago. Actually, it was an IRS audit regarding hobby versus business. And I proved that there was a profit in the farm operation. Very small loss on the farm. It was like a $2,000 or a $3,000 Schedule F loss. Been that way for many years. But the appreciation of the real estate as documented on the tax bills, property tax bills, the assessors increased the valuation of the property over 10 or 15 years. That increase in appreciation, as documented, exceeded the amount of losses we were deducting on Schedule F. Pass the test, no loss exists, case closed, pass. Business versus hobby, hot off the press. New York State's got their eyes on farmers. You want the business to look and breathe and smell and taste like a business, not a hobby. If it's a hobby, if your enterprise, if you will, is a hobby, you're in it for the fun of it. It isn't so fun on the tax return because you get the privilege of paying income tax, regular income tax on all of your income, and you don't get to deduct any of the expenses. Now, in all likelihood, it's not going to be a huge amount of money. Typically, hobbies have a few $1,000s of activity going on in a year. But having said that, you end up with $2,000 or $3,000 of income, and you don't get to take any of the deductions. So there's my business versus hobby. I talked about NYS IT 217, the farmer's school tax credit. You have to have 2/3 of your gross income come from farming, and there's a $30,000 gimme, if you will. Is it worth it to farm, or the taxes of selling out? I'm not exactly sure where that question was going, Caitlin, if you can help me out with that one, but how I'm reading into that is this: should I keep going and losing money, or should I just get out? And how deep is the well? How long do you want to subject yourself to funding this losing enterprise? That is the business decision that you need to make. It's probably not a tax decision. It's more of, how long do I want to fund this thing? So that's how I'm going to steer that question. I hope that's okay. Kind of the same thing on the last question here: how long can I lose? And my parents own the land. I get some income from selling hay. You've got a very good deal with your parents that they still own the real estate. You're generating some income from selling hay, but it's always at a loss. How long can you substantiate? How long can you substantiate and survive in that kind of environment? It takes money to keep things going. I think you're probably living on the hopes and dreams of an appreciating asset, and someday, if or when, you'd be able to sell the thing and make piles of money or something. In the short term, a tough question. How long can you survive? There was a question from an apple grower in regards to timing of production and the year of sale. And it's, I hate to try to answer this very specific question in generalities, but I'm going to have to stay on generalities. And if the individual producer would like to circle back around with myself or anybody else, I'd be glad to talk to them. But one of the avenues of planning in regards to apple growers specifically is in the timing of reporting of when crop insurance proceeds are taxable. If the crop would normally be produced this year and sold next year, produced this year, put in cold storage, sold next year, if I have a big loss and I have crop insurance proceeds replacing that normal sale that would have been next year, I can make an election and have the crop insurance proceeds actually taxable next year. That's a timing game. And that's about where I'm going to go with our apple grower example at this point. Some entity considerations. We're winding up here. Thank you, everybody, for staying with me. I've probably gone too long here. Husband-wife LLCs. LLCs, limited liability companies, are state statute entities. A husband and wife LLC is a partnership. Files a Form 1065. They do not get a salary. There is no salaries paid to a member of an LLC. They are the owners. They take draws. So they get paid through draws. Draws coming out of a partnership or an LLC is money distributed in anticipation of there being taxable income at the end of the year that you're going to pay tax on. You're taking it out ratably over time. A draw, a guaranteed draw, mirrors a salary, but it's not on a W-2.
Paul?
Caitlin?
Yep, I have a question that goes right along with that. They're asking, they're filing as a Schedule F, sole proprietorship. How do I record withdrawals from my farm checking account when I take money out from personal expenses like household or as household income? Does that show up on my taxes?
There is no Schedule F line of an expense for a sole proprietor's draws. The sole proprietor draw is not an expense that's deducted on the tax return. The draw would be as the result of there being earnings generated. Good, that's a good thing, right? You pay income tax on the net Schedule F profit. If the stars are perfectly aligned, the net schedule F profit has been your draws taken out year to date. If the stars are perfectly aligned. Come on, they're never perfectly aligned. You're going to take $1,000, $2,000 a month, something out of that business every week, every month, whatever. That is a distribution, a draw. It's nothing to do with a profit and loss report. It's a draw. This is a complicated question, honestly. It's just 2 lines. Does an LLC capital account delay taxation until a K-1 distribution? There's a lot of moving parts and moving big words in that question. So typically through a partnership LLC environment, there's draws by each of the members taken out of the business, and the draws impact their capital accounts. And there's no income tax consequence to a draw. They are accounted for in the capital account of the entity. Only when there's an eventual sale or transfer of that partnership interest do you have to worry about the capital account activity where those draws have been coming out of. The capital account increases with profits, decreases with draws. And that's about where I'm going to go with entities. Kind of a bigger question, but hopefully I've answered that. Rental agreements between entities. Have them written between entities. Real estate LLC, operating entity LLC. Please have those rental agreements written. One of the tax credits that we've captured in the past has been the manufacturer's real property tax credit. It's 20% typically of the qualifying town and county taxes on our farms, 20% refunded on the state tax return, in addition to the farmer school tax credit. Good stuff. But if the business, the operating entity, doesn't pay the tax, the rental activity is not eligible for the credit. The tax credit goes with who paid the property taxes. The rental agreement has to stipulate that the operating entity pays the tax in lieu of rent. Learned from experience, I lost once. Farm income averaging, oh boy, just love it. I could go on for a long time and I'm over time. So I could go on. So I'm sorry, folks. Do you have examples of rental agreements between entities? I'm not an attorney. I'm not professed to be an attorney. We have very basic agreements. I would say seek legal counsel. To me, they're legal documents. We have consultants on staff that work with our farm clients to do these types of arrangements, and then they take the consulting reports to their attorney. The attorney does their legal spiegel, and there you have it. So I'm open for questions. You got me.
Paul, you were going to talk about 2 audit
situations.
Oh,
another audit. Yes,
yes,
thank you. Another audit. Okay. Yep. Thank you very much. Our office has had 2, in my opinion, well, 1 really large partnership audit just concluded with no change. That's like home run. Okay, go us. How did that come about? We had really good records. Okay, everything was very well documented. Now there's a but coming, right? Yeah, there's a but coming. But IRS has a new target, and it pertains to Form 1099 miscellaneous reporting. Our farm client had a variety of custom contractors, machine hire, rental activities. where we had prepared most of the 1099 miscellaneous forms for those vendors, but not all of them. $540 penalty per 1099. The tax return, no change. And this is a big audit, but there's still a penalty coming because the auditor has identified, and I don't know how many, more than one 1099 recipient that didn't get a 1099. A 1099 miscellaneous is for rent, custom hire, that's a 1099 NEC, non-employee compensation. Our typical farm returns, the renting the neighbor's farm field for a pasture, for whatever, rent over $600, subject to 1099 reporting. You need the recipient's name, address, social security number, or EIN number. Yeah, a bunch of neighbors are not going to be very pleased about this. Well, IRS doesn't really care. The second audit that we just concluded, again, no change, but it's a 1099 audit issue. The auditor found one 1099 missing, was a $2,500 custom expense. Auditor provided us the option. Lose the expense, in other words, farmer, you get to pay the tax on $2,500, or pay the penalty on the late filed 1099. Well, the tax was less than the penalty. We opted to pay the tax, okay? Why do I bring this out? I've got an audience here of businesses that are paying people, if you will, casual, I don't want to say casual labor, but custom hire, machine hire. I'm hiring the guy next door to do all the baling of my hay for me, and shares maybe even. That's a 1099 reportable event. You need that neighbor's name, address, social security number, EIN number, and report it. Those 1099s have to be prepared, provided to the recipient and IRS by January 31st. January is not a fun month for Paul. Sorry.
Got a couple more 1099 questions if you're up for them.
Oh, I should get my chat going here. I'm sorry.
That's okay. There, we've got some people that are sending direct messages. So the first one is livestock processing considered something that they would have to file 1099?
Yeah, that's a service. To me, that's a service. Absolutely. Mm-hmm. Yep.
And
now,
then
if the recipient is a corporation, yeah, this is interesting. You don't have to provide it to a corporation. So Livestock Processing Inc., corporation don't have to provide it. Livestock Processor LLC, sorry, an LLC, it says limited liability company. Yeah, it's not a corporation, it's a limited liability company. That's reportable. Veterinarians, the service provided by a veterinarian is a medical payment. That's a reportable transaction.
Okay. The other 1099 question is that if you barter, do you need a 1099? So we talked about creating a paper trail for bartering services. If you receive something in kind over that $600 limit, does a 1099 need to be filed if it's not a cash payment?
That's a tough one. The right answer is yes, 1099 reporting applies to cash or services. It's a reportable event. How do you value, what's the value that's going to be assigned to that transaction? It's got to be some mutually agreed upon amount. And in that vein, you're talking to the person, so they ought to give you your information required, the address and ID number. Okay.
And then one question that came in earlier, if a farmer donates unsold produce to a charity, how do they record this?
Okay. I have a few vegetable operations that make charitable donations to food pantries. And I think that's the requirement, that the donation has to go through a food pantry. And then there is a tax credit on the New York State return. At least that's how I am recalling. I don't recall there being an income tax deduction. I think it's a tax credit based on the value of the produce given to the food pantry. If you will, you've already taken the deductions for fertilizer or property taxes or repairs or whatever in harvesting the crop. You've already taken that tax deduction. You're not going to have to show the income. You're making a charitable contribution, only we're calling it a contribution of food to a food pantry. Now you take a tax credit. Some nuance to the language there, sorry.
There's just,
okay, yeah, $599 is a good number.
It's amazing.
For the whole year, not per transaction, for the whole year. Under 600.
So one other question that came in earlier, could we revisit how farmers can determine what to pay for quarterly taxes? What value do we use for these calculations?
The farmers that I have making quarterly estimates are very few in number. I am utilizing the previous year's tax liability, number one. And number two, I don't think I have five farm clients that make quarterly estimated payments. I have several clients that make one estimated payment by January 15th of, if you will, 2022, equal to the 2020 tax return. So let me kind of restate that. I look at the 2020 tax return, the tax that was calculated on that, I have the farmers make one estimated payment on January 15th, the next year. And then they have until April 15th to file and pay the balance due. It works really well in the year of a farm sale. Really well. Why do I say that? The previous year, I paid very little, if any, tax. I want to pay that tax by January 15th. And then I don't have to part with all of my money and pay the big tax until April 15th. Time value money. I want the money in my pocket rather than Uncle Sam. So.
And then I'm trying to, so there was a question when we were talking about audits. So a farmer is saying that when they've been filing their taxes, they have to sign a piece of paper that says that they've reviewed it for accuracy and completeness, and sign off on it and return. Mm-hmm. With that signature, in the case of an audit, how does handling the liability and the paperwork fall? And it came in as an anonymous question, so hopefully I asked that correctly.
Okay.
I think I understand what they're getting at.
My guess is that tax preparers, tax professionals handle this in a variety of different fashions. How I hope our office is handling it, how I would handle it anyway, would be this. The tax liability is going to be the tax liability. If there's an ultimate change in the tax liability, that's frankly, it's out of our control. If the audit has ultimately changed the tax liability. However, penalties that may be assessed, we bear penalties collectively, okay? I'm human. I make mistakes. We all are human. Honest enough mistake, you know, I'm sorry. We'll eat the penalty. I don't normally offer up the interest because frankly, the farm had use of that change in tax liability and wouldn't have had the cash in their account anyway. So Our stance is that we'll negotiate through on penalties, but not the interest on a change. Obviously, we don't like many changes, right? And, you know, knock on wood, I think I don't know, in 38 years, if full-blown audits, I probably have had 10 full-blown audits in 38 years. Folks, not very many. I've had a lot of New York State letters. Oh, holy smokes. These hobby loss things, those are all letter formulated. They're not coming out to the farm. It's all just by letter. And it's not fun. I'm thinking of one client that I helped, and I use the word defend, guilty until proven innocent, prove that the farm is a business, okay? That it's not a hobby. Because if it's a hobby, we're gonna throw out all the expenses. You get to show the income, no expenses. That's a bad deal, okay? I submitted like 300 pages to New York State to document every single expense. Invoice, bank statements, plural. They mixed funds, thank you. So not one bank statement, but two. Every receipt. It was like 300 pages. And I felt awful for the client. The client's going out of business. The farm's for sale. Yes, they still have a farm loss. I'm sorry. They have an off-farm income. They're still paying off-farm debts. Is it a hobby? I don't think so. It's a business, but it's going out of business, right? And that client, I passed on 19. They got a second letter for 2020. Unbelievable. I'm really frustrated with New York State. Terrible. Thank you, Nicole, for putting up my contact information. I did have it on my screen. I think it's in the slide packet that you sent out to everybody today. So I didn't get a chance to get to that slide. God, Dayton, it goes long. It goes fast, though.
Oh, it's good information, Paul. Rich, excellent information.
I did want to add, we did have a couple of record keeping, bookkeeping type questions come in. And I wanted to share that our next income tax, or our next course in the tax school series taught by Joan Petson will cover that completely. So we kind of skipped some of those questions just in the interest of time, and definitely encourage everybody to check out the rest of the courses that will touch on some of those questions too. So I'm thinking that looking at the clock and thanking Paul for hanging in with all of our wonderful questions, and thanking all of you for sharing all the wonderful questions, we'll go ahead and get wrapped up. I'm going to drop the course evaluation link in here again, and everybody will be receiving copy of the recording, copy of the questions, and copy of the slides. So in that case, if you want to drop off, go ahead and drop off. Paul, if you want to stay on, I think we just got a couple more questions that came in last minute.
Yeah,
we can do that.
Any issue in doing a 1099 miscellaneous when I really didn't need to? In other words, is the service or rent less than $600? I don't think there's a penalty for underreporting, but if it was $601 and you should have, you got to do the 1099. So I guess that's how I would answer that question, Jim. That was one that I did see, Caitlin. I don't know if you got any more personal chats.
Yeah, we had one more. I think everybody's scared of getting audited. So,
hey, I don't like them either, right?
Yes.
But in all honesty, even with more money getting thrown at IRS so that they can audit more, yeah, the chances are like less than 1%. Okay, do a good job, keep records well. What are they going to find? You got to prove where you are and substantiate it. And you know, I couldn't be happier that our 2 audits went through with no change. That to me is great. And I'm talking millions of dollars through a big partnership. That's a big audit with a no change. The last audits that I have had, I'm talking full-blown audits, not these stupid New York State letter things. The last audits that I had have been no change. They are not fun. It's an aggravation. Your blood pressure rises, right? You're feeling like you're on the hot seat. if you do a good job and you document things well, what are they going to find? They're not going to find anything. So don't be overly worried about being audited, I guess. I am a little worried in New York State in regards to the losses with farms and refunds. They seem to be picking on those clients. We had like 20 letters. Crazy, but.
So we had a question along with that too, asking how many years back can you be audited?
Normally 3 years. You can only go back 3 years to amend, so only 3 years are open. Normally. And I hope this doesn't ever happen, if there is an intentional disregard, I knowingly underreported. No open, the doors are open, okay? You can go back to the beginning of time. Not a good situation. That's knowingly, okay? Intentional disregard, that's bad. We're not going down that road. If you're looking for, I hate to say it, if you're looking for us to be that preparer, you're going to have to look for another preparer because we're not going to go down that road. Okay. No, we have to sign that return. I'm an enrolled agent, enrolled to practice before Internal Revenue Service. I had to sit for an exam for that. I've got to keep up my hours every year for education and et cetera, et cetera, et cetera. So no. Anyway. I see a question here. If we are responsible for paying property taxes in addition to land rent to the landlord, should the property taxes be included in the 1099 or an expense? What I would say is the 1099 should report the entire rental agreement, the cash rent for the acreage plus the property taxes, and your calculation in how much you pay for the property in rent should incorporate the property tax bill as best as you can, okay? It's a win-win situation. And frankly, the landlord shouldn't have a problem in setting up a lease agreement in this fashion. Let me phrase it like this. Bare piece of land, 100 acres, $35 an acre, $3,500, right? Plus the taxes. Whatever taxes I have to pay on my 100 acres, I get to deduct on my rental schedule. The farmer pays that $5,000 in property taxes, right? It's more than I'm getting in rent, in cash rent. I have the farmer pay the $5,000 in property taxes. The 1099 is $8,500. The $5,000 of taxes plus the cash rent, $3,500. On my expenses for rental schedule is $5,000 of rental of property taxes. My net profit's $3,500. Even Steven, right? No change. But $5,000 of property taxes just became eligible for a 20% manufacturer's real estate tax credit to the farmer. 20% of $5,000. Yeah, that's $1,000. Not bad. Paid my fee. Got to use it when you can. Next.
So I think that's all of them. I'm just double checking. So it looks like we've caught all of the income tax related questions that weren't super specific. So we will say that if you had a very specific question to your individual business, we didn't cover that, and definitely would recommend that you work with your personal tax preparer. If you had any questions that weren't answered in that evaluation survey, there's a spot where you can ask those. They might have gotten missed or lost in the shuffle. So go ahead and type that question back in there, and we'll be sure to include it in the Q&A document too. Dayton and Nicole, do you guys see anything else.
No, I think we're in good order, Caitlin. Yeah. And I just want to thank Paul for such a wealth of information.
Absolutely.
You're very welcome. I'm sorry it's gone over time. I lost track of my timing. So it's some of these topics are kind of near and dear, so I can talk for a long time. Schedule J, oh my God, it's really powerful. A lot of time it's disregarded, but it's a big saver. Farmer school tax credit, yeah. I know there was going to be questions about hobbies and everything. I hope I've addressed that. And anyway, making money is a good thing, right? Have a business plan. Use that business plan. Amend the business plan. Yeah. Been fun.
All right.
All right.
Well,
you're very welcome.